90% traders fail in the market, not because of strategy, but because of their mindset. Trading psychology expert Mark Douglas explained this in his famous book, Trading in the Zone. In this video, you'll discover 15 secret rules that can completely change the way you think about trading. Most traders enter the market with one goal in mind: making money. They watch charts, learn strategies, and search for the perfect setup. But very few of them truly understand the first and most important rule of trading. Before you enter any trade, you must accept the risk. This idea was strongly emphasized by trading psychology expert Mark Douglas in his famous book, Trading in the Zone. According to him, the difference between a struggling trader and a consistently profitable trader is not intelligence, strategy, or even experience. The real difference is how they think about risk. Most beginners place a trade believing it will work. They expect the market to move in their favor. But the moment the market moves against them, something emotional happens. Fear appears. Suddenly, their mind starts searching for hope. They tell themselves things like, maybe the market will turn around. Let me hold the trade a little longer. I don't want to close this trade in a loss. And because of this emotional reaction, a small loss slowly becomes a big one. Professional traders think very differently. Before they enter a trade, they already accept one simple truth: this trade might lose. And they are completely okay with that. This mental acceptance removes fear. When the risk is accepted in advance, the trader no longer feels shocked if the trade goes wrong. Instead of reacting emotionally, they simply follow their plan. This is why professional traders always define their risk level before entering the market. They decide three things clearly: where they will enter the trade, where they will exit if they are wrong, and how much money they are willing to lose. That last part is extremely important, because in trading, losses are not failures. Losses are simply part of the game. Even the best traders in the world lose trades regularly. The difference is that they keep their losses small and controlled. When you accept risk before entering a trade, something powerful happens inside your mind. Your emotional pressure disappears. You stop trying to force the market to prove you right. Instead, you begin to think in probabilities. You understand that no single trade defines your success. What matters is the long-term consistency of your decisions. This mindset allows you to stay calm, disciplined, and focused, even when the market becomes unpredictable. And this is exactly what Mark Douglas meant when he talked about being in the zone. It's a state where a trader is not controlled by fear, greed, or hope. Instead, they simply execute their plan and trust the probabilities. However, accepting risk is only the beginning. Because once you understand risk, you must also learn another powerful truth about the market, a truth that many traders struggle to accept. And that brings us to the next powerful principle. Rule number 2, the market is always right. In the next rule, we'll explore why successful traders never argue with the market, and how understanding this idea can completely change the way you trade. After learning the first principle of trading, accepting risk, there is another powerful idea that every successful trader must understand: the market is always right. This concept was strongly emphasized by trading psychology expert Mark Douglas in his famous book, Trading in the Zone. At first, this idea may sound strange. Many traders believe that if they analyze charts carefully, follow indicators, or study the news, they can predict exactly what the market will do. But the truth is very different. The market does not care about your analysis. It does not care about your opinion. And it definitely does not care about your prediction. The market simply moves based on the collective actions of millions of traders and investors around the world. That means even if your analysis seems perfect, the market can still move in the opposite direction. And when that happens, many traders make a critical mistake. Instead of accepting that the market has moved differently, they start arguing with the market. They say things like, "This stock should go up. My analysis says the price must rise. The market is wrong." But the reality is simple. The market is never wrong. Price movement is the only truth that exists in trading. Professional traders understand this very clearly. They never try to prove that they are right. Instead, they focus on responding to what the market is actually doing. If the market moves in their favor, they manage the trade properly. If the market moves against them, they exit the trade without hesitation. They don't take it personally, they don't feel embarrassed, and they don't try to win the argument. Because in trading, arguing with the market can be extremely expensive. Imagine a trader who buys a stock expecting it to go up, but instead the price begins to fall. A disciplined trader will quickly accept that the market is moving differently than expected and close the trade. But an emotional trader might hold the position longer and longer, hoping the market will come back. This hope can turn a small loss into a very large loss. Successful traders avoid this trap by accepting one simple rule. Their opinion does not control the market. The market controls the outcome. Once you truly accept this idea, something powerful happens in your mindset. You stop trying to predict the market with certainty. Instead, you begin to observe and adapt. You become flexible. You follow the price instead of fighting it. This mindset shift is one of the most important steps toward becoming a consistent trader. Because trading is not about being right all the time, it is about managing risk and responding to reality. And reality in trading is always defined by price action. That is why professional traders say, trade what you see, not what you think. When you learn to respect the market instead of fighting it, your trading becomes calmer, clearer, and more disciplined. However, understanding that the market is always right leads to another important realization. If the market cannot be predicted with certainty, then how do successful traders still make money consistently? The answer lies in the next powerful principle. Rule number 3, think in probabilities. In the next rule, we'll discover why the best traders in the world don't try to predict the market. Instead, they learn to play the probabilities. Once you understand that the market is always right, the next powerful rule becomes clear. Successful traders think in probabilities. This concept was explained deeply by trading psychology expert Mark Douglas in his famous book, Trading in the Zone. Most beginner traders make one common mistake. They believe every trade must be a winning trade. When they enter the market, they expect the price to move exactly as they predicted. But trading does not work that way. No strategy in the world can guarantee that every trade will win. Even the most experienced traders lose trades regularly, and that is completely normal. The real secret of professional trading is understanding that trading is a game of probabilities, not certainties. To understand this idea, imagine flipping a coin. If the coin is fair, there is a 50% chance of heads and 50% chance of tails. But that doesn't mean the results will always alternate perfectly. Sometimes you might get heads 3 or 4 times in a row. Sometimes you might get tails several times in a row. But over many flips, the probabilities eventually balance out. Trading works in a very similar way. A trading strategy may have a 60% probability of success. That means out of 10 trades, about 6 may be winners and 4 may be losers. But those wins and losses will not happen in a predictable order. You might lose 3 trades in a row and still be using a profitable strategy. This is where many traders fail. After a few losses, they start doubting their system. They change their strategy. They change indicators. They abandon their plan. But professional traders understand something very important. They know that a single trade means nothing. What matters is the result of many trades over time. That is why they focus on executing their system consistently. They don't try to predict the outcome of every individual trade. Instead, they trust the probabilities of their strategy. This mindset removes emotional pressure. When a trader thinks in probabilities, they stop feeling devastated after a loss. Because they already understand that losses are simply part of the statistical process. They also avoid becoming overconfident after a win. They know that a winning trade does not mean they are always right. This balanced mindset helps traders stay calm and disciplined. Professional traders often think like casino owners. A casino does not worry about the outcome of a single game. They know that some players will win. But because the odds are in the casino's favor, they will make money over hundreds and thousands of games. Successful traders think the same way. They focus on long-term probabilities instead of short-term outcomes. Once you adopt this mindset, your relationship with trading changes completely. You stop chasing perfect predictions. Instead, you focus on executing your edge consistently. And this is the mindset that allows traders to stay calm even during losing streaks. However, understanding probabilities leads to another important rule. Even if you have a profitable strategy, it will only work if you follow it with discipline. Because many traders know a good strategy, but they fail to follow it consistently. And that brings us to the next powerful principle. Rule number 4, follow your trading plan. In the next rule, we'll explore why discipline is often more important than strategy in the world of trading. Once traders understand probabilities, the next rule becomes critical. Always follow your trading plan. Many traders spend months learning strategies, indicators, and chart patterns. But the real challenge is not creating a trading plan. It is sticking to it. Trading psychology expert Mark Douglas explained in his book, Trading in the Zone, that discipline is one of the biggest differences between amateur traders and professional traders. A trading plan is simply a set of rules that guide your decisions in the market. It defines when to enter a trade, when to exit a trade, how much risk to take, when to stop trading. Without a clear plan, trading quickly becomes emotional. Imagine a trader who opens the market without any rules. He sees the price moving quickly and suddenly feels the urge to enter a trade. Sometimes the trade works, sometimes it fails. But because there is no clear system, every decision becomes emotional. Fear and greed begin to control the trader. One moment the trader is excited after a winning trade. The next moment he becomes frustrated after a losing trade. This emotional roller coaster often leads to inconsistent results. Professional traders avoid this situation by relying on a structured trading plan. Before they even open their trading platform, they already know what conditions must be present before entering a trade. If those conditions are not present, they simply do nothing. This ability to wait patiently is a key trait of disciplined traders. Following a trading plan also helps traders avoid impulsive decisions. In fast-moving markets, emotions can easily take control. A trader might feel the fear of missing out and jump into a trade too quickly. Or they might close a winning trade too early because they fear the market might reverse. But when a trader trusts their plan, these emotional reactions become less powerful. Instead of reacting emotionally, they simply follow the rules they have already defined. Another important benefit of a trading plan is consistency. If you follow the same strategy repeatedly, you can measure its performance over time. You can identify what works and what needs improvement. But if you constantly change strategies or break your own rules, it becomes impossible to know whether your system is actually profitable. Professional traders understand that consistency is the foundation of long-term success. They treat trading like a structured business rather than a gamble. Every decision follows a rule. Every trade follows a system, and every risk is carefully controlled. Of course, following a trading plan is not always easy. There will be moments when emotions tempt you to break your rules. You might feel the urge to enter a trade early. You might feel tempted to hold a losing trade longer than planned. But the traders who succeed are the ones who stay disciplined even during these moments. They trust their system more than their emotions. Over time, this discipline creates a powerful advantage. Because while many traders act impulsively, disciplined traders continue to execute their plan calmly and consistently. However, even with a strong trading plan, another challenge remains. Many traders take too many trades, believing that more trades mean more opportunities to make money. But in reality, overtrading is one of the fastest ways to lose discipline in the market. And that leads us to the next important principle. Rule number 5, avoid overtrading. In the next rule, we'll discover why sometimes the best trading decision is simply to stay out of the market. Many traders believe that the more they trade, the more money they will make. They sit in front of their screens for hours, watching every price movement, waiting for the next opportunity. Every small movement in the market starts to look like a potential trade. But this is one of the most dangerous habits a trader can develop. Overtrading is one of the fastest ways to destroy both your capital and your discipline. Trading psychology expert Mark Douglas explained in his well-known book, Trading in the Zone, that successful traders do not trade more. They trade better. Beginner traders often feel that they must always be in a trade. If the market is moving, they feel the urge to participate. This feeling is known as FOMO, the fear of missing out. They think, maybe this is the move I was waiting for. What if the market runs without me? I should enter before it's too late. Because of this mindset, they begin taking trades that are not part of their plan. Sometimes these trades work, but many times they do not. Over time, this constant trading creates several problems. First, it increases transaction costs such as spreads, fees and commissions. Second, it drains your mental energy. Trading requires focus and discipline. When you take too many trades, your mind becomes tired, and tired traders make poor decisions. Third, overtrading increases emotional pressure. When you have too many positions open at the same time, your attention becomes scattered. Instead of calmly managing one good trade, you are suddenly trying to manage many uncertain trades at once. Professional traders approach the market very differently. They understand that opportunities do not appear every minute. Good setups are rare, and that is perfectly okay. Instead of forcing trades, professional traders wait patiently for the market to present a clear opportunity. They understand that sometimes the best trade is no trade at all. This patience is what separates professionals from impulsive traders. Think of a professional hunter waiting for the right moment. A hunter does not shoot randomly at every movement in the forest. He waits for the perfect opportunity. Traders must develop the same mindset. They wait for the exact conditions defined in their trading plan. If the setup is not there, they stay out of the market. This ability to wait may feel uncomfortable at first. Many traders feel bored when they are not trading. But boredom is far less dangerous than impulsive trading. The market will always offer new opportunities tomorrow. There is no need to chase every price movement today. Professional traders also understand that quality is more important than quantity. One well-planned trade is far more valuable than 10 emotional trades. Over time, this disciplined approach protects both your capital and your confidence. When you stop overtrading, your decisions become clearer. You become more selective, more patient, and more consistent. And this mindset is exactly what Mark Douglas believed was necessary for traders who want to stay in the zone. However, even disciplined traders will face losses. Losses are an unavoidable part of trading. No strategy can eliminate them completely. So the next rule focuses on something that every successful trader must learn to accept. Rule number 6. Losses are part of the game. In the next rule, we'll explore why accepting losses is one of the most powerful mental skills a trader can develop. Every trader enters the market hoping to win. They study charts, analyze patterns, and search for the perfect opportunity. But one truth about trading can never be avoided. Losses are part of the game. Many beginner traders struggle with this idea. When they experience a losing trade, they feel frustrated, angry, or even discouraged. Some traders begin to doubt themselves. Others start blaming the market. But according to trading psychology expert Mark Douglas, successful traders understand something very important. A losing trade does not mean you are a bad trader, and a winning trade does not necessarily mean you are a great trader. In his famous book, Trading in the Zone, he explains that losses are simply a natural cost of doing business in the market. Just like any other business, trading also has expenses. For example, a store owner might pay rent, electricity, and employee salaries. These expenses are necessary to keep the business running. In the same way, losses are part of the cost of trading. Professional traders understand this very clearly. They do not expect to win every trade. Instead, they focus on managing their losses properly. When a trade goes against them, they exit the trade calmly and move on to the next opportunity. They do not take the loss personally. They do not try to immediately recover the money by making emotional trades. And most importantly, they do not allow one loss to destroy their discipline. Beginner traders often make the opposite mistake. After a losing trade, they try to revenge trade. They quickly open another position, hoping to recover their loss immediately. But this emotional reaction usually leads to even bigger losses. Professional traders avoid this trap by maintaining a calm mindset. They understand that losses are simply one small part of a much larger series of trades. A single trade does not define success. What matters is the overall performance across many trades over time. This perspective allows traders to stay emotionally balanced. Instead of fearing losses, they accept them as a normal part of the process. And when you remove the fear of losing, something powerful happens. Your decision-making becomes clearer. You no longer hesitate to follow your trading plan. You no longer panic when the market moves against you. You simply manage the trade according to your strategy. This calm mindset is one of the most important traits of successful traders. Because in trading, emotional control is often more valuable than technical knowledge. Charts, indicators, and strategies are important. But without the ability to accept losses, even the best strategy can fail. That is why Mark Douglas believed that mastering your mindset is the key to long-term trading success. However, understanding losses leads to another powerful realization. Even if you accept losses, your success still depends on one critical skill: discipline. Because without discipline, traders often break their own rules and sabotage their strategy. And that brings us to the next principle. Rule number 7, discipline is everything. In the next rule, we will explore why discipline is the foundation of consistent trading success. By now you understand that trading is not only about strategy, charts, or indicators. The real challenge in trading is discipline. Many traders know what they should do in the market. They know where to place a stop loss, when to enter a trade, and when to exit. But when the real moment arrives, emotions begin to take control. Fear tells them to close a trade too early. Greed tells them to hold a trade longer than planned. Impatience pushes them to enter trades that are not part of their strategy. And this is where most traders lose consistency. Trading psychology expert Mark Douglas explained in his well-known book, Trading in the Zone, that discipline is one of the most important qualities of a successful trader. Discipline simply means doing the right thing, even when emotions try to push you in the wrong direction. Professional traders build their discipline by following clear rules. They enter trades only when their setup appears. They exit trades exactly where their plan says to exit, and they never allow emotions to override their system. This may sound simple, but it is not easy, because the market constantly tests a trader's patience and emotional control. Imagine a trader who has a clear rule. If the trade reaches my stop loss, I will exit immediately. But when the price approaches that stop loss, the trader starts thinking, maybe the market will bounce back. Maybe I should give it a little more room. I don't want to accept this loss. This moment is where discipline truly matters. A disciplined trader follows the rule exactly as planned. An undisciplined trader breaks the rule and hopes for the best. Over time, these small decisions make a huge difference. Disciplined traders build consistency and confidence. Undisciplined traders experience emotional highs and lows. Another important part of discipline is patience. Professional traders understand that not every moment in the market is a good opportunity. Sometimes the best decision is simply to wait. Waiting can feel uncomfortable for many traders. They want action, they want excitement, they want to feel like they are always doing something. But trading is not about constant action. It is about making the right decision at the right time. And that requires patience and discipline. Think of discipline as the bridge between strategy and success. Without discipline, even the best trading strategy will fail. But with discipline, even a simple strategy can produce consistent results. Over time, disciplined traders develop a strong mindset. They stop reacting emotionally to every market movement. Instead, they follow their system calmly and consistently. This is exactly the mindset that Mark Douglas described when he talked about being in the zone. It is a mental state where a trader is focused, calm, and fully committed to their process. However, even disciplined traders must learn one more important lesson, because sometimes the biggest enemy in trading is not the market, it is our own ego. And that leads us to the next powerful principle. Rule number 8, control your ego. In the next rule, we will explore why ego can quietly destroy even the most talented traders. One of the most dangerous enemies in trading is something many traders don't even notice at first. Ego. When traders enter the market, many of them want to prove that they are right. They believe their analysis must be correct, and they want the market to confirm their prediction. But the market does not work that way. The market does not care about your opinion, your analysis, or your ego. Trading psychology expert Mark Douglas explained in his famous book, Trading in the Zone, that successful traders learn to separate their ego from their trading decisions. Beginner traders often connect their personal identity to their trades. When a trade wins, they feel proud and confident. But when a trade loses, they feel embarrassed or frustrated. Because of this emotional attachment, they start making irrational decisions. For example, imagine a trader who enters a trade expecting the price to go up, but instead the market starts moving down. A disciplined trader will quickly accept the mistake and close the trade. But an ego-driven trader thinks differently. Instead of accepting the loss, they begin arguing with the market. They say things like, "My analysis is correct. The market will turn around. I will not close this trade until I am right." This is where ego becomes dangerous, because the trader is no longer focused on managing risk. They are focused on proving themselves right. And in trading, trying to prove you are right can be very expensive. Professional traders understand a simple truth. Being wrong is part of trading. They do not feel ashamed when a trade fails. They simply accept the result and move on to the next opportunity. Their goal is not to prove they are right. Their goal is to protect their capital and follow their system. When you remove ego from trading, your mindset becomes much clearer. You stop fighting the market. You stop trying to predict every move perfectly. Instead, you focus on executing your strategy consistently. This shift in mindset allows traders to stay calm even when things don't go as expected. They understand that one trade does not define their success. What matters is the long-term result of many disciplined decisions. Professional traders often say something very powerful. It's not about being right, it's about making money. That statement perfectly captures the difference between emotional traders and disciplined traders. Emotional traders want to prove they are right. Professional traders simply follow the process. And this mindset keeps them focused, flexible, and prepared for whatever the market does next. However, controlling ego also leads to another important realization. If you focus too much on money, profits, or losses, your emotions can easily take control again. That is why successful traders learn to shift their focus away from money itself. And that brings us to the next important principle. Rule number 9, focus on the process, not the money. In the next rule, we'll discover why focusing on the right process is the real key to long-term trading success. Most traders enter the market thinking about one thing: money. They constantly check their profit and loss. They watch every price movement and immediately calculate how much they are gaining or losing. But focusing too much on money can actually damage your trading decisions. Trading psychology expert Mark Douglas explained in his famous book, Trading in the Zone, that successful traders focus on the process, not the money. Why is this so important? Because when traders focus only on money, emotions begin to take control. If the trade is in profit, greed appears. The trader starts thinking, maybe I can make even more. I should hold this trade longer. But when the trade moves into a loss, fear appears. The trader thinks, I should close this quickly. I don't want to lose more money. These emotional reactions often cause traders to break their own rules. Instead of following their strategy, they start making decisions based on fear and greed. Professional traders think differently. They understand that money is simply the result of a good process. Their main focus is not the profit of one trade. Their focus is on executing their trading plan correctly every time. For example, before entering a trade, they ask themselves questions like, does this trade match my strategy? Is the risk within my limit? Is the setup clear and confirmed? If the answers are yes, they take the trade. If not, they simply wait for the next opportunity. By focusing on the process, traders remove emotional pressure. They stop worrying about the outcome of each individual trade. Instead, they concentrate on making consistent, disciplined decisions. Over time, this approach builds confidence, because the trader knows they are following their system correctly. And when a trader consistently follows a good process, profits usually follow naturally. Think of trading like professional sports. A great athlete does not focus on the final score during every moment of the game. Instead, they focus on their technique, discipline, and execution. The score becomes the result of their performance. Trading works in the same way. If you constantly watch profits and losses, emotions will control your decisions. But if you focus on executing your strategy correctly, your performance will improve over time. This is one of the key mindset shifts that separates professional traders from beginners. Professionals trust the process. Beginners chase the money. And in the long run, the traders who focus on the process are the ones who build consistent success. However, even when traders understand the importance of process, another common mistake still appears. Many traders keep changing their strategy again and again. Every time they see a loss or a new indicator, they switch to something new. But this constant change destroys consistency, and that leads us to the next powerful principle. Rule number 10, stick to your strategy. In the next rule, we will explore why constantly changing strategies is one of the biggest mistakes traders make. One of the biggest mistakes many traders make is constantly changing their strategy. Today, they follow one indicator. Tomorrow, they try a completely different system. And a few days later, they are watching another new strategy on the internet. This constant switching creates confusion and inconsistency. Trading psychology expert Mark Douglas explained in his famous book, Trading in the Zone, that successful traders develop confidence by sticking to one strategy and executing it consistently. Beginner traders often believe that if a strategy produces a losing trade, it must be a bad strategy. So they immediately search for something new. But this thinking is dangerous. Every trading strategy experiences losses. Even the best systems in the world cannot win every trade. When traders abandon their strategy after a few losses, they never give the system enough time to prove its true potential. Professional traders understand this very clearly. They test their strategy carefully. They study how it performs over many trades. And once they are confident in the system, they commit to it with discipline. Instead of constantly searching for something new, they focus on executing the same strategy consistently. Consistency is what allows traders to measure their performance. If you follow the same strategy over time, you can learn from your results. You can identify strengths, weaknesses, and areas for improvement. But if you change strategies every week, it becomes impossible to know what is actually working. Another reason traders keep switching strategies is emotional pressure. After a losing trade, they feel uncomfortable and begin doubting their system. They start thinking, maybe this strategy doesn't work anymore. Maybe another strategy is better. This doubt pushes them to jump from one system to another. But professional traders know that confidence comes from experience and repetition. The more consistently you apply your strategy, the more familiar you become with its behavior. You begin to understand when it works best and when conditions are not ideal. Over time, this knowledge builds trust in your process, and that trust allows you to remain calm even during losing streaks. Think about a professional athlete. They don't change their entire technique after one bad performance. Instead, they practice the same fundamentals repeatedly until they master them. Trading works the same way. Mastery comes from consistency, patience, and repetition. When you commit to one strategy and execute it properly, your confidence grows. Your decisions become clearer, and your results become more stable. However, sticking to a strategy requires another important skill, because even the best strategy will only work if you have the patience to wait for the right opportunity. Many traders lose discipline because they cannot wait. They feel the need to act immediately, and that leads us to the next powerful principle. Rule number 11, patience is the key. In the next rule, we will explore why patience is one of the most powerful advantages a trader can develop in the market. In trading, many people believe success comes from acting quickly. They think the fastest traders are the ones who make the most money. But in reality, one of the most powerful skills a trader can develop is patience. Trading psychology expert Mark Douglas explained in his famous book, Trading in the Zone, that successful traders are not always the most active traders. They are often the most patient ones. Beginner traders often feel the need to constantly do something. They watch the charts closely and feel pressure to enter a trade quickly. When they see the market moving, they think, maybe this is the opportunity. I shouldn't miss this move. I need to enter before it's too late. Because of this mindset, they enter trades that do not fully meet their strategy. This impatience leads to poor decisions and unnecessary losses. Professional traders approach the market very differently. They understand that not every moment in the market is a good opportunity. Most of the time, the market is simply moving randomly. That is why disciplined traders wait for the right setup, the one that perfectly matches their trading plan. This waiting period can sometimes feel uncomfortable. There may be hours or even days when the market does not present a clear opportunity, but professional traders are comfortable with this. They know that patience protects their capital. Think of patience as a filter. It prevents you from entering low-quality trades. Instead of chasing every movement, you focus only on the best opportunities. When the right setup finally appears, patient traders are ready to act with confidence because they have waited for the moment that truly fits their strategy. This patience also helps traders remain emotionally balanced. When you are constantly jumping into trades, your emotions become unstable. But when you wait calmly for your setup, Your mind stays focused and disciplined. Professional traders often follow a simple idea. Wait for the trade to come to you. They do not chase the market. They allow the market to present the opportunity, and when that opportunity appears, they execute their plan with precision. Over time, this patient approach creates consistency. Instead of taking many random trades, traders begin taking fewer but higher quality trades. And these higher quality decisions often lead to better long-term results. This is why patience is considered one of the most valuable traits in trading. It protects you from impulsive decisions. It strengthens your discipline, and it keeps your focus on the opportunities that truly matter. However, patience alone is not enough. Even when you wait for the right setup, you must still know how to manage risk when the trade goes wrong, because no strategy can avoid losses completely. And that leads us to the next important rule. Rule number 12, cut losses quickly. In the next rule, we'll explore why successful traders never allow small losses to become big losses. In trading, losses are unavoidable. Every trader, no matter how experienced, will face losing trades. But what separates successful traders from struggling traders is how they handle those losses. Trading psychology expert Mark Douglas explained in his famous book, Trading in the Zone, that professional traders follow one important rule: cut losses quickly. Many beginner traders make a common mistake. When a trade moves against them, they hesitate to close the position. Instead of accepting a small loss, they begin hoping the market will reverse. They tell themselves things like, maybe the price will come back. I'll wait just a little longer. I don't want to close the trade in a loss. Because of this hesitation, a small loss slowly becomes a much bigger loss. This emotional attachment to a trade can damage both the trader's capital and confidence. Professional traders approach this situation very differently. Before they even enter a trade, they already know exactly where they will exit if the trade goes wrong. This level is called the stop loss. The stop loss acts like a safety net. If the market moves against the trader, the position is closed automatically, limiting the loss. Professional traders respect their stop loss completely. They do not move it further away to avoid accepting a loss. They do not ignore it because of hope. They simply follow their plan. This discipline keeps losses small and controlled. And controlling losses is one of the most important skills in trading. Think of trading like protecting your capital. If you protect your capital, you always have another opportunity to trade. But if one large loss damages your account, recovering becomes much more difficult. Successful traders understand that small losses are normal. They treat them as part of the trading process. Instead of fearing losses, they focus on managing risk effectively. Over time, this mindset builds confidence, because the trader knows that no single trade can cause serious damage. Another benefit of cutting losses quickly is emotional stability. When traders hold losing positions for too long, stress and anxiety increase. But when losses are controlled early, the trader can move on calmly to the next opportunity. Professional traders often follow a simple rule: take small losses and let winners grow. This philosophy keeps their trading balanced. Small losses protect their capital, while winning trades create profits over time. This mindset is exactly what Mark Douglas believed was necessary to stay mentally strong in the market. However, cutting losses quickly is only one part of the equation, because if traders close their winning trades too early, they may still struggle to achieve consistent profits. And that leads us to the next powerful principle. Rule number 13, let winners run. In the next rule, we'll explore why successful traders allow their profitable trades to grow instead of closing them too early. Many traders learn to cut their losses, but they make another common mistake. They close their winning trades too early. As soon as the trade shows a small profit, they quickly exit the position. At first, this feels good. The trader sees profit and feels successful. But over time, this habit can limit trading success. Trading psychology expert Mark Douglas explained in his famous book, Trading in the Zone, that successful traders understand an important principle. Let your winning trades run. Beginner traders often close winning trades too early because of fear. They worry that the market might suddenly reverse. They think, I should take my profit before it disappears. What if the price drops suddenly? It's better to secure this small gain. Because of this fear, they close the trade quickly. But this creates a serious problem. Their profits stay small, while their losses sometimes become larger. Professional traders follow a different mindset. They understand that big profits come from letting strong trades continue moving. Instead of closing the trade too early, they allow the market to move as long as the trend remains strong. Of course, this does not mean holding a trade forever. Professional traders still follow a clear exit plan. They may use techniques such as trailing stop losses or predetermined profit targets. These methods allow the trade to continue growing while still protecting profits. This balance between protecting profits and allowing growth is very important, because in trading, a few strong winning trades can often cover several small losses. Imagine a trader who cuts losses quickly but allows winning trades to grow. Over time, the larger wins begin to outweigh the smaller losses. This creates a positive trading result. But if a trader constantly closes winners too early, they may never fully benefit from strong market movements. Professional traders trust their strategy. When a trade is working and the market supports the trend, they remain patient. They allow the trade to develop naturally instead of reacting emotionally to every small price movement. This mindset requires confidence and discipline, because watching a profitable trade move up and down can test a trader's emotions. But traders who stay calm and trust their system often capture the most powerful market moves. This is one of the key ideas that Mark Douglas emphasized when discussing successful trading psychology. Small losses should be accepted quickly, but profitable trades should be given the space and time to grow. When traders combine these two principles, cutting losses quickly and letting winners run, their trading performance often improves dramatically. However, even with strong strategies and disciplined risk management, there is one final ingredient that every successful trader must develop. Without it, traders may still struggle during difficult moments. And that final principle brings us to the next rule. Rule number 14, believe in yourself. In the next rule, we'll explore why confidence and self-belief play a critical role in long-term trading success. In trading, strategies, charts, and indicators are important. But there is another powerful factor that many traders overlook: self-belief. Without confidence in yourself and your system, it becomes very difficult to trade consistently. Trading psychology expert Mark Douglas explained in his famous book, Trading in the Zone, that successful traders develop strong belief in their process and their ability to follow it. Many beginner traders struggle with confidence. After a few losing trades, they begin to doubt themselves. They start thinking, maybe I'm not good at trading. Maybe my strategy doesn't work. Maybe I should stop trading. These doubts create hesitation, and hesitation can cause traders to miss good opportunities or make emotional decisions. Professional traders understand that confidence does not come from never losing. Confidence comes from trusting your strategy and executing it consistently. They know that even a good strategy will experience losing trades. But instead of doubting themselves, they stay focused on the bigger picture. They believe in their process. This belief allows them to stay calm during difficult periods. When the market becomes unpredictable, confident traders do not panic. They continue following their rules. They trust that their strategy will perform well over a series of trades. Self-belief also helps traders maintain emotional control. When you believe in your system, you are less likely to chase random opportunities. You are less likely to abandon your plan after a few losses. Instead, you remain focused and disciplined. However, it is important to understand that self-belief must be based on preparation and experience. Professional traders build their confidence through practice. They test their strategies. They study the market. They review their past trades and learn from their mistakes. Over time, this preparation creates a deep understanding of their system, and this understanding builds real confidence. Think of it like a professional athlete. An athlete believes in their ability because they have practiced their skills thousands of times. The same principle applies to trading. Confidence grows through learning, testing, and disciplined execution. When traders develop this level of belief, their mindset becomes stronger. They stop doubting every decision. They stop reacting emotionally to every small loss. Instead, they trust the process and continue moving forward. This is the mindset that Mark Douglas believed was necessary to stay mentally strong in the market. But there is still one final principle that completes this powerful trading mindset. Because trading success is not built on one trade, one strategy, or one moment. It is built on consistent thinking and disciplined behavior over time. And that leads us to the final rule. Rule number 15. Consistency creates success. In the final rule, we'll explore how consistent thinking and disciplined actions lead to long-term success in trading. After learning all the previous principles, the final rule brings everything together. Consistency is the key to long-term trading success. Many traders believe that success in trading comes from one big trade or one lucky opportunity. But the reality is very different. Successful trading is not about one moment. It is about consistent decisions over a long period of time. Trading psychology expert Mark Douglas explained in his famous book, Trading in the Zone, that professional traders develop a mindset focused on consistent behavior. They follow the same rules again and again. They manage risk carefully. They stick to their strategy. They control their emotions. Over time, this consistency creates stability in their results. Beginner traders often chase excitement. They want quick profits and dramatic market moves. Because of this, they constantly change strategies, take impulsive trades, and react emotionally to market movements. But this behavior leads to inconsistent results. Professional traders approach the market like a disciplined business. They understand that success does not come from one perfect trade. Instead, it comes from hundreds of well-executed decisions. Every trade they take follows their system. Every risk they take is controlled. Every decision is guided by discipline rather than emotion. Think of trading like building a strong structure. Each disciplined decision is like a brick. One brick alone does not create a building. But when many bricks are placed carefully and consistently, a strong structure is formed. Trading success works in the same way. One good trade does not make a successful trader, but consistent behavior over many trades builds long-term profitability. Consistency also strengthens a trader's mindset. When you follow your rules repeatedly, you begin to trust your process. You stop reacting emotionally to every win or loss. Instead, you focus on executing your strategy with patience and discipline. This mindset creates the calm confidence that professional traders are known for. They do not chase the market. They do not panic during losses. They simply follow their process and allow the probabilities to work over time. This is exactly the mental state that Mark Douglas described as being in the zone. A state where a trader is calm, focused, disciplined, and fully committed to their system. When traders reach this level of consistency, trading becomes less emotional and more structured. Decisions become clearer. Confidence becomes stronger. And long-term success becomes possible. Because in the end, trading success is not built on luck. It is built on discipline, patience, and consistent thinking. And when you combine all 15 rules from Trading in the Zone, you begin to develop the mindset of a truly professional trader. If you truly want to become a disciplined and profitable trader, don't just watch this video. Apply these rules in your trading journey. The principles shared by trading psychology expert Mark Douglas in his legendary book, Trading in the Zone, have changed the mindset of thousands of traders around the world. So if you found value in this video, make sure to like the video, subscribe to the channel, and share it with someone who wants to master trading psychology. And remember, the market doesn't reward the smartest trader. It rewards the most disciplined one. I'll see you in the next video.